Hi all, we're going to get started here in just a minute. Hope everyone's having a good Thursday. Okay, well, let's go ahead and get started. So good afternoon and welcome to today's webinar, where we'll be discussing the distressed housing market and what is on the horizon. My name is Jennifer von Pohlmann, and I'm the Director of Content and PR here at ATTOM Data Solutions. So now here's a brief overview of some items that will be discussed in today's webinar. We'll give you a quick introduction about who is ATTOM Data Solutions, as well as the various data products and solutions that ATTOM offers, before diving into what you all came for, which is a detailed analysis on the future of the distressed housing market. Now, please feel free to submit your questions throughout the presentation through the question box, and I'll be sure to get back to you within 2 business days. Also, as a reminder, you will be receiving a copy of this webinar the following business day. So now ATTOM Data Solutions is your one-stop shop for premium property data with flexible delivery solutions. Our mission is to power real estate transparency and to fuel innovation across various industries with the most comprehensive property data. Now, we've built a multi-source national data warehouse that blends property tax, deed, mortgage, foreclosure, environmental risk, natural hazard, and neighborhood data for more than 155 million U.S. residential and commercial properties, which covers 99% of the U.S. population. Now, we've recently introduced our new table of data elements, where we have expanded our list of categories from 4 to 10, which is both a combination of bringing some new data elements as well as a natural expansion of categories that we feel best represent the various data sets that we offer. We have property ownership, and this is kind of where we track a lot of our information about individual properties and the data within these categories, as well as our transaction data provided to customers with much of the core data assets for their business. And then you have transactions/mortgages consists of any data related to sale and mortgage data for individual properties, as well as any derivatives created from this data. And then, of course, foreclosures, which provides detailed information of homes in any stage of the foreclosure process. Valuation, which captures all the data that provides value and valuation insights of a property. And then school, hazard, and neighborhood. These 3 categories really capture relevant lifestyle data about the community where a property is located. And then, of course, boundary data. Our boundary shapes define an area on a piece of land. These shapes are created using geographical information systems, GIS data, and can be digitally superimposed onto a digital map. Many of our customers utilize our boundary shape files and present the boundaries on a map or to use within a database to determine if a point, like a property, is within a specific boundary. It's very useful for real estate search, risk identification, and target marketing. And then, of course, listings. As part of our acquisition of Home Junction last year, this data includes active listings, sold listings, listings photos, and much more. The data is updated frequently and is standardized in common formats. Now, lastly, we offer a variety of data solutions to meet your business needs. For instance, the ATTOM API is one of our delivery solutions through which much of our analytics-ready data can be delivered, such as bulk data licensing, market trend reports, and more. We're also the first property data provider of Data as a Service, or DaaS. It's a cloud-based property data platform that streamlines data management. Now, our data is not a one-size-fits-all. Our flexible delivery options give you a choice when it comes to how you consume the data and also how much data you want to consume. We tailor our solutions to meet the challenges and opportunities in your industry and for your specific objectives. So now let's dive into what you all came for. Here you will see a historical foreclosure starts and an REO chart dating back to 2005. As you can see, foreclosure starts continue to drop dramatically across the U.S. This trend continues amid a strong housing market and federal moratorium on foreclosures, affecting federally insured mortgages. This moratorium affects about 70% of home mortgages around the country. Now, as you can see, foreclosures dropped almost 80% in Q4 2020 versus Q4 2019, and are off more than 95% since peaks in 2009. Now, there were about 565,000 foreclosure starts in Q2 09 and just 17,200 in Q4 2020. Now, REOs which are bank-owned properties, are down by about the same rate as overall foreclosures. We saw about 290,000 REOs in Q3 2010 and just 6,600 in Q4 2020. Now, these drops over the past decade can largely be due to booming housing market, values rising, equity rising, way more incentive to avoid foreclosures. Now, cases will likely keep dropping until the foreclosure moratorium is lifted, which is still in place until June 30th for now, but numbers will probably increase after the moratorium is lifted. Now, how fast they will increase will likely be tied closely to how well the economy recovers. Now, if the recovery is really mixed, then foreclosures will most likely increase notably. However, if the economy is going strong with the job market, then the increase will likely be less notable as people will be able to get back up to date with mortgage payments. Now, here we take a look at zombie foreclosure cases across the nation, which is somewhat of a non-issue for now across the U.S. Just about 67 homes sit vacant in the foreclosure process in Q1 2021. This is down from about 9,600 in Q3 2018. So about 1 in 26 homes in the foreclosure process are empty. Since so few properties face foreclosure, zombie foreclosures account for only 1 in 14,800 or so of all residential properties across the nation. Now, higher priced metropolitan areas, mainly in the West, have the lowest rate of zombie foreclosures. Now, Midwest and low price metro areas, especially Northeast and Midwest, have higher levels. Similar factors driving down overall foreclosures also drive down the number of zombie properties. So now with that said, I would really like to pass it over to Rick Sharga, Executive Vice President of RealtyTrac, a leading foreclosure search and discovery website used by real estate agents and investors that is powered by ATTOM. Go ahead and take it away, Rick.
Thank you, Jennifer. I appreciate that, and I appreciate ATTOM inviting me to be here today. For those of you who aren't familiar with RealtyTrac, as Jennifer mentioned, we are a search and discovery website for people looking for foreclosure information. We publish the largest database of foreclosure properties in the country. A good source for below market and off market inventory if you're an investor or an agent who works with investors, and also a really good source for investors or agents who are looking to identify financially distressed homeowners in the early stages of foreclosure. And those people would typically benefit from selling their property prior to a foreclosure sale taking place. A lot of the kind of data that Jennifer was talking about is also available on the RealtyTrac database, powered, as she said, by ATTOM. So property characteristics, valuation, schools, crime, and other neighborhood reports. And if you're interested in more about that, visit the website, realtytrac.com, or you can call the 800 number there. And again, as Jennifer mentioned, a recording of this will be going out, so you'll have a chance to get that number later on. Wanted to talk a little bit today about what we're seeing in the market. And I think the best way of describing a lot of what we're seeing right now is a word that typically has to do with people wandering through the desert or visiting Las Vegas. The word is mirage, and it's a definition of something that appears real or possible, but really is not in fact so. And I think there are two mirages that we're seeing right now. One is the foreclosure numbers and delinquency numbers we're seeing, I believe, are a mirage. They're not representative of the reality of the marketplace, and they're not realistic because of intervention that we've seen on the part of the government and the industry for very, very good reasons. And the second is a common theme that I see on social media all the time. I hear from people that get to participate in events like this, and it's that what we're seeing today is going to lead to a repeat of the foreclosure tsunami we saw in the Great Recession. I believe that's also a mirage. And we're going to go through a series of things that lead me to this conclusion, and I think will hopefully help everybody frame what's most likely to be happening in the world of foreclosures as we get through this pandemic together. There are a number of key differences between today's market and what we saw during the Great Recession when we did see that foreclosure tsunami. Two that I'd like to point out right away are superior loan quality and government and industry intervention. Superior loan quality probably was nowhere more evident than what we saw that led to the Great Recession and how we saw loans performing prior to the pandemic. And if you looked at the numbers that Jennifer was showing in terms of foreclosure activity, you could see that once we peaked back in 2009, foreclosure numbers started to drop pretty significantly over the ensuing decade. And we saw the same thing in mortgage delinquency rates. And you can take a look at this chart and see that once we peaked, again, back in the 2008, 2010 time period, delinquency rates got back to normal and actually got better than average for a number of years before we hit the pandemic. Then you started to see these delinquency rates spike. And the way this chart is broken out, it's loans that are in various stages of delinquency but not yet in foreclosure. So the green bars are the ones that the press is paying the most attention to these days. Those are the loans that are seriously delinquent. So really, anytime a loan goes 60 to 90 days or more past due, it winds up in that seriously delinquent bucket. This is one of the mirages that we're looking at in the data today. The fact that we have historically high levels of seriously delinquent loans is because of an unusual set of circumstances that started with the pandemic and then quickly followed that by government intervention that was part of the CARES Act that was instituted last March once the pandemic was declared. If you take a look at these seriously delinquent loan numbers, what you're really looking at is the number of loans that are in the CARES Act mortgage forbearance program. These are borrowers who were given the option of not making their monthly mortgage payments because their income was impacted by the COVID-19 coronavirus, and they've opted to do so. One of the things you won't read much about in the press right now is that until February numbers were reported just recently, we'd seen consecutive declines in all levels of delinquency rates. And while it's true that the rates are higher than they were a year ago, they've been rapidly returning to normal levels at the earlier stages. So if you take apart just those borrowers who are in the forbearance program and look at the other borrowers, what you're seeing is delinquency rates that are actually now lower than they were prior to the pandemic. I've mentioned the forbearance program a couple of times, and I think it's worth mentioning again, because this is really what causes a lot of confusion and has a lot of people thinking that we're going to wind up with a ton of properties in foreclosure once the pandemic is over. We actually saw a peak of about 8.8% of borrowers in the forbearance program after it was introduced back in March of 2020. Those numbers are now down to just slightly over 5% of all loans. That still represents about 2.5 million borrowers. But as you can see, the peak was nowhere near as high as what some of the gloom and doom forecasts were calling for when the program was first announced. And the numbers have been generally coming down on a month-over-month basis. So again, 2.5 million people's in the forbearance program. It's still a lot of people there, but the numbers are trending in the right direction. An even more dramatic way of looking at this is if you take a look at the number of people requesting to be part of the forbearance program. We saw an enormous spike when the program was announced back in March, right before April mortgage payments were due. And I would submit to you that if the situation with borrowers was getting worse and not better, we would have seen subsequent peaks at the end of April, the end of May, the end of June, end of July, and so forth and so on, as the next month's mortgage payment was coming due. And in fact, we've seen just the opposite of that. In fact, in the most recent week, we saw the percentage of borrowers who've requested a forbearance go down from 0.07% to 0.05%. So virtually nobody is really requesting new entry into these programs right now, which to me suggests that the market is probably healthier than a lot of people think it is. There's another number I'd like to call to your attention that I think has the potential to be misinterpreted. 86% of people in the forbearance program today are there on some sort of extension or have re-entered the program. And rather than this being a sign of weakness, I believe this is actually a sign that the program is working exactly the way it was intended to work. If you remember when the government put the program in place, it gave borrowers an initial 180-day forbearance with an option of a second 180 days. When mortgage servicers started to implement this program, they very seldom gave borrowers that entire 180-day session to start with. So in many cases, they would give somebody a 90-day forbearance. The borrower would then have to ask for an extension for another 90 days, and so forth and so on. So again, the program is working exactly as it was intended to work. And one of the key differences in what we're looking at today, compared to what we would normally be looking at, is because of the CARES Act forbearance program, a borrower can literally not make a payment for 360 days. And on the 361st day, go from being a year past due to current simply by agreeing to a repayment program with his or her lender. And that, in fact, as you'll see in a couple slides, is primarily what's taking place right now. But again, it's in my mind a very, very healthy sign that just a little over 13% of the people in forbearance are there on their initial round of forbearance. It suggests, again, that the market is probably a lot healthier than most people expected it to be. This is probably one of the most encouraging charts that anybody who's interested in the housing and mortgage market can take a look at as far as what's happening with the forbearance program, and why I'm very optimistic that at the end of the day, we're not going to see the 2.5 million people in forbearance become 2.5 million people in foreclosure. If you take a look at everybody who's exited the program beginning last June, which was when the program was 3 months old, through the middle of March, excuse me, 86% have exited successfully. And what does that mean? That means that 27% have never missed a payment and just continued to make their payments as they left. Another 15% had their loans reinstated by the lender. Another 26% had a deferral or partial claim made. And this is the program, the part of the program that the government is really encouraging all of the lenders to participate in. It takes all of the missed payments and basically puts them at the very end of the mortgage. So that the payments aren't due until the property is sold, the loan is refinanced, or the mortgage is actually termed out. Another 8% had their loans modified. Another 8% just about paid the loans off, either through selling the property, paying the loan off, or getting a refi. So only about 14% of the borrowers who have been in this program have left without a plan in place. Some of those were the 2% that have re-entered the forbearance program. They were people who should have stayed in, but simply weren't able to connect with their servicer before their program expired. But this is probably the most vulnerable group of everybody in forbearance, and the ones most likely to potentially default on their loan once they exit. And if you keep that in mind, there's 2.5 million people in the program. That means that about 350,000 of those people are the most vulnerable to a foreclosure or default. So we know the loans were better. They were performing much better prior to the pandemic than we'd seen on average historically. About 0.6% of loans were in foreclosure. About 3.5% of loans were in some stage of delinquency, both below historical averages. We've seen massive government and industry intervention that's designed to keep people from unnecessarily losing their home to a foreclosure. The third big reason that I don't expect a tidal wave of foreclosures is the nature of the recession. We've never seen a recession like this in the history of the country. And this recession was caused not by a weak underlying economic reason, but it was caused because basically the pandemic had the government forced the government to shut the economy down. Keep in mind that the U.S. economy depends on consumer spending for 70% of the GDP. And basically consumers were told to stay home and told they couldn't buy anything, they couldn't order on Amazon, or perhaps get toilet paper if it was in stock at the local grocery store. So there's no big surprise that the economy took a huge hit in the second quarter, a drop off of over 31%. The good news is that was an expected number, and the government had already taken steps to kind of mediate the worst of that. The better news is that it wasn't as bad a drop as a lot of economists had called for. There were a lot of economists expecting a 45 or 50% drop. And the best news of all is that in the third quarter, we saw the economy spring back by over 33%. Now, if you're like me and sometimes struggle with basic math, I should point out that a 31% drop followed by a 33% increase doesn't mean you're back to even. We're still a little bit behind where we were. But the fact of the matter is that it was a very, very short, very, very steep recession, very unusual historically speaking. Another reason this is a very different recession is that jobs are recovering much more quickly than they have in prior recessions. If you look at that Great Recession, that's the blue line, the 2007 employment recession, it took the better part of a decade for us to get back to where we were in terms of jobs before that recession hit. If you look at the current recession, you see that huge V that took place in the first couple of months before job growth started to slow down. But that's a very, very atypical recovery in terms of jobs lost during a recession. And the fact of the matter is that the jobs continue to come back much more quickly than I think even our most optimistic forecasts would have predicted. The February jobs numbers were particularly strong, almost 380,000 new jobs created in the month of February, and more than half of the jobs lost have already been recovered. So again, a very unusual, very atypical kind of recovery in this recession. And this recession was also unusual in that it skewed very heavily toward a handful of industries: hospitality, leisure, travel, tourism, restaurants, retail, entertainment. And these are all trades that are populated by employees who tend to be at the lower end of the wage scale. They tend to be hourly employees. They tend to be younger. They tend to have less formal education. And because of that, they tend very, very largely to be renters rather than homeowners. It's one reason why we've lost 22 million jobs and didn't see the kind of devastation you'd normally see in housing numbers when it came to those job losses. So in addition to the government intervention, in addition to the borrowers who are already in the housing pool being very strong, high quality borrowers, the recession really has behaved very differently and really focused primarily on renters and in many cases renters who weren't even really on the cusp of home ownership. High income jobs, the jobs that are more likely to be held by homeowners and potential homeowners, have recovered much more quickly. The national rate of unemployment right now is about 6.2%. And if you take a look at some of those higher paying jobs in the finance, insurance, telecom, professional and technical services industries are all at about half that rate or lower. Whereas on the other hand, if you look at some of those other industries I was talking about, whether it's retail, food services, entertainment, so forth, all of those are running 2 to 3 times the average rate of unemployment. So the jobs coming back really need to start recovering more quickly. And as the economy begins to open up, as more and more people get vaccinated, as it feels like the pandemic is coming more under control, we should start to see those jobs come back as well. The fourth big difference between today's market and the Great Recession is the market dynamics of the housing market itself. If you remember going into that Great Recession, we had really horribly underqualified borrowers getting adjustable rate mortgage loans using teaser rates. When those loans reset, the borrower simply couldn't afford the properties. The home builders had banked on the boom continuing, so that it actually overbuilt, and we had too much supply, not enough inventory, lending tightened up, so there were no loans available, and market prices fell through the floor, about 35% nationally. We couldn't have a more opposite market dynamic today than we had back then. Existing home sales, which fell off a cliff when the pandemic was declared last March, rebounded and actually were up almost 6% on a year-over-year basis, 2019 to 2020. And if you look at what happened in March, April, May, and June of last year, when home sales just dropped significantly on a year-over-year basis and even on a month-over-month basis during what's historically the highest home sales time of the year, it would have been hard to predict that home sales would have rebounded as strongly as they did. But look at the second half of the year. And it was just unusually, extraordinarily strong. And that momentum carried into 2021. Existing home sales were up almost 24% in January. And despite the headlines that you saw this week that home sales fell, well, yeah, they fell off one of the highest Januaries in history, but they were still up about 9% on a year-over-year basis from last February. And last February, keep in mind, was pretty strong because it was before the pandemic fell. I would encourage you, as you're looking at home sales numbers through the course of the year, to be aware of what I'm referring to as the COVID bias, not the COVID virus, but the COVID bias. We're looking at numbers that are going to be compared to a year that was completely countercyclical. So the numbers through the spring are going to look ridiculously strong as we get into March, April, May, and June, where the numbers were artificially low last year. But as we get into the second half of the year, if normal cycles prevail, you're going to probably see the sales in 2021 look relatively weak compared to last year. But it doesn't mean the housing market is weak. It means the numbers are being compared to an unusually strong period of time. We're seeing these sales despite the fact that inventory levels are as low as they've ever been since the NAR started reporting the numbers. We're down to about 2 months supply of homes available for sale nationally. That's the lowest it's ever been in a normal market. We usually see about 6 months of supply. So you're seeing about a third of the inventory that we would need to get back to normal. And on a year-over-year basis, the numbers are off, depending on your market, anywhere from 20 to about 60%. But nationally, year-over-year inventory numbers are about 30% lower than they were a year ago. And they weren't all that strong a year ago. So one of the questions I do get periodically is, what happens if we see a flood of foreclosure homes? Will that skew the numbers in terms of home prices? And my answer is probably not. We would have to see something along the lines of 2 million properties hit the market just to get us back to normal. And I don't see any way feasibly possible that we're going to see that many distressed properties hit the market. The new home market has been equally strong, actually a little bit stronger on a percentage basis. Most forecasters were calling for somewhere in the neighborhood of 700,000 new homes being sold last year. As you can see, the number was significantly higher than that, up again almost 20% on a year-over-year basis, and again off to a good start this year. And what's really interesting about those new home sales is almost none of them are entry-level homes. Very difficult for the builders to make any money at all selling an entry-level home. According to Fannie Mae, it costs a builder about $80,000 before they break ground. Lumber costs are escalating, labor costs are escalating, labor is scarce, so they're having trouble keeping pace. And in fact, what we're seeing is that more and more buyers are actually under contract pre-construction. So the blue section of this chart that you're looking at is homes that are under construction today. The red area is homes that are completed. And as you can see, the number of completed homes is down. Again, record levels of low inventory, and more buyers are buying homes really when the ground is broken and while they're under construction. Again, completely the opposite of where we were during the run up to the Great Recession, where builders were building, hoping buyers would show up later. So why aren't there more homes available? Really 5 reasons. Builders have underbuilt for about a decade, really since the Great Recession. Probably 300 to 400,000 fewer homes a year than they really needed to be building. So we're catching up for a decade of underbuilding. Americans are aging in place. You can blame the baby boomers for this one too. The average time somebody stays in a house today is almost 11 years. A decade ago, that was somewhere between 5 and 6 years. So boomers are increasingly deciding to age in place. And even Gen Xers are kind of stuck in place right now because they're often caring for their elderly parents who've moved in with them, or they need the room for their adult children who've moved home while they can't find work because of the pandemic. So we're seeing people stay in place longer. COVID-19 has caused a bit of a drop in existing home inventory. People are reluctant to put their homes on the market because they don't necessarily want strangers coming through their house during a pandemic. And they also don't necessarily want to be going out to open houses themselves to tour homes that are owned by strangers where they might catch the coronavirus. The lack of inventory has also created a bit of a vicious cycle. People are afraid to put their home on the market because they're not sure there's anything for them to buy. So where will they live if they do sell the house? And the low interest rates really have incented a lot of people to stay put. This will be more and more of a problem as interest rates continue to go up. Demand continues to be strong. If you look at the Mortgage Bankers Association's purchase application numbers, you can see that the green bar there shows that 2021, the number of people applying for a loan is about 5.5% higher than it was a year ago. That number will look, again, kind of artificially stronger as we go through the spring. But the MBA is forecasting more purchase activity this year than last year. And as we mentioned, last year was stronger than the year prior. So the demand is still definitely there. For those of you wondering where the demand's coming from, a lot of it's driven by demographics. Most of it actually is driven by demographics. The largest group of millennials are rapidly approaching the median age of a first-time homebuyer. And Gen Xers are starting to approach the median age of a repeat buyer. So demographics really is the basic reason why we're seeing a lot of this happening. Also, historically low interest rates, even though they've ticked up over the last week or so as bond yields have gone up, we're still at the low end of historic averages. If you look at the last 25 years, the average mortgage rate's about 7.5% to 8%. So a mortgage rate of 3% is still way low historically speaking, and that's driving a lot of people to buy rather than to rent because their mortgage payment, because of these low rates, is often less than what they pay for their own rent. Adam just did a report on affordability across the country and showed that in more than half the markets, it's actually cheaper to buy than to rent. And this is something the American Enterprise Institute has coined the Great American Land Rush. It's a movement we were already seeing as millennials were exiting their urban rental properties and moving to the suburbs. But because of COVID, because of the quarantine, and people wanting more space both in their home and around their homes, and because more and more people are now able to work from home, we're seeing a lot of people, particularly on the coasts and especially in high price, high tax areas, becoming more and more aggressive and active in moving to the suburbs. So those three things are really driving a lot of the demand: demographics, low interest rates, and some of these trends that COVID has accelerated. More supply is finally on the way. If you look at housing start numbers, you're seeing that the builders are finally coming around and building more and more single family residencies, and that will help to alleviate some of the problems we're having. The fifth idea here that I'd like to communicate with you, and a major difference between where we are today and the Great Recession, is homeowner equity. I talked about the nature of loan quality leading up to the Great Recession, and a lot of people had loans that they really weren't qualified for with no or very low money down on the properties. Today, homeowner equity is at an all-time high, and it's driven to a great extent by the fact that this situation we have with historically low inventory and strong demand continues to drive prices higher. According to the American Enterprise Institute, they believe that by the time we get to April, we'll see home prices up year over year on a 12 to 14% basis. That's not a sustainable number, and at some point it will offset the savings of those lower interest rates. But it's the reality of what we're dealing with right now. And it's even more of an issue when you look at price tiers. The lowest property prices are the ones that are rising the most quickly. But literally in just about every category of price tier of home, we're seeing double-digit year-over-year price growth. And what that's doing, in addition to driving the prices up, it's driving homeowner equity up. And so we're at historically high levels of homeowner equity. ATTOM Data has done some reports on homeowner equity that suggests that about 70% of homeowners have more than 20% equity. There have been more reports published that discuss the fact that even 90% of the people in the forbearance program have more than 10% equity. And this gives people optionality if they do find themselves in financial distress. If you were a homeowner during the Great Recession who suddenly found yourself in default and you were underwater on your loan, you had a multitude of problems and really didn't have a lot of good options. And because of that, a lot of homes wound up being foreclosed on and going back to the lenders. In today's market with this kind of homeowner equity, there's really a much better option. There's an escape that homeowners can execute if they want to avoid that foreclosure and sell the property instead. All that said, there are some areas of potential vulnerability. One of them is the commercial real estate market. And if you look at these numbers that we just put together today at ATTOM Data, we can tell that foreclosure activity in the commercial sector is ratcheting up pretty significantly. Now, I do want to point out these are based on small sample sizes. If you look at the number of commercial properties that are over $5 million, you're certainly going to have far fewer of those than you're going to have households. But given the nature of this recession, the fact that it hammered the hospitality market, it hammered the retail market, it hammered the restaurant market, it even has some concerns because of the office market. If you're an investor looking for investment opportunities in distressed assets, I would suggest those are sectors of the commercial market where you're probably going to find some of those opportunities over the next year to 18 months. And these numbers are not likely to be coming down anytime soon. We are seeing delinquencies come down in the mortgage industry. Mortgage-backed security delinquency rates are coming down, but they're still artificially or unusually high in the retail and hospitality sectors. The FHA portfolio is the one part of the housing market where I do have some concerns. If you take a look at delinquency rates, you can see that over 11% of FHA loans are seriously delinquent, and that's more than twice the average of everything else. FHA borrowers tend to be at the low end of the wage scale, tend to have less in the way of cash reserves, tend to have lower down payments, and therefore lower equity. These are the borrowers who may not be able to weather the storm if their jobs don't come back as the recession ends and the economy recovers. The AEA's done some digging. They've discovered that 70% of FHA loans overall were delinquent, and they list markets like Atlanta, Chicago, Houston, Dallas, DC, Riverside in California, Baltimore, San Antonio, Orlando, and Tampa as markets that you might see FHA delinquencies turn into FHA defaults as some of these government programs expire. And that's simply because of the volume of FHA loans in those markets. I'd also call your attention to the nature of jobs in some of these markets. Markets like Orlando, very heavily dependent on travel and tourism. Look at markets like that, markets like Las Vegas, as potential weak spots as we go forward. And then the third area of potential weakness is the rental market. I mentioned this earlier. There are eviction bans in place that make it very difficult for a landlord who's dependent on rental payments to make their own payments, their mortgage payments, tax payments, maintenance, insurance payments, and so forth. And you can see that as much talk as there is about missed mortgage payments, almost twice as many renters are missing payments as are mortgage holders. The other number I think worth showing here is how many student loan borrowers are missing their payments. And in fact, there's a much higher likelihood that student loan holders are going to be renters than homeowners at this point. So that's kind of a double-barreled issue to think about. And you're looking at the rental markets, and we are starting to see an indication that rent payments are falling behind on a year-over-year basis. In this particular survey, if you look through the month of February, about a 2-point drop year over year. And if you look at March, about a 4% drop through the first couple of weeks of the month. And that doesn't sound like a lot, but there are 40 million people renting properties. So a 4% drop represents a couple million people, and it's really worth paying attention to. So those are the three areas I see as being particularly vulnerable as we get into foreclosures, and just kind of give you my perspective and the RealtyTrac perspective on what we're going to see in foreclosures. First, you can't lose 22 million jobs and not have an increase in foreclosures, but we don't see the rise being exponential. Loan quality was excellent. Heading into the pandemic, the economic recovery is outpacing expectations. The vaccine is being distributed much more quickly and broadly than expected. Government industry intervention is providing borrowers with a lot of time, and time is hugely important. That forbearance program has now been extended to 18 months. So a lot of people are given a lot of time to work their way out. And we're even seeing lenders behave differently. They're proactively working with borrowers who can't reconnect and can't get back on their feet, to offer them the opportunity to do short sales today. There's record homeowner equity that gives those distressed homeowners a cushion. And my personal belief is that the majority of distressed properties are likely to be sold during the early stages, what we call the pre-foreclosure part of the foreclosure process. So anybody looking to invest in foreclosure should be looking earlier in the cycle, not later. And then this drastic supply and demand imbalance really provides a viable alternative for distressed homeowners and lenders. And because of that, I think it's highly unlikely we're going to see the REO levels balloon like they did during the last cycle. So how many foreclosures? Nobody really knows, but let's throw some numbers out just as a frame of reference. There were about 250,000 loans that were in foreclosure prior to the pandemic. Most of them are still outstanding, some in forbearance, some not, but most of them haven't been resolved. Of the 2.5 million loans in forbearance, about 14% are likely to exit in a vulnerable stage. That's about 350,000. And if you look at the rate of foreclosure activity entering the pandemic, it was about 0.6% of the loans that were in foreclosure. Given the number of mortgages today, that'd be 330,000. Let's assume that all 250,000 loans that were in foreclosure are still in foreclosure, that all 350,000 people that might be vulnerable go into default, and that we have another 330,000 people enter foreclosure because that's just the rate of activity we were seeing before the pandemic. If all of them were in foreclosure, it would be about 930,000 loans in some stage of foreclosure, or about 1.7% of loans. Historically, the average is about 1%, and we peaked at the Great Recession at about 4%. I think it's really unlikely we're going to see all three of the things I just talked about hit all at once. But even if they did, we would be at less than a half of the rate of foreclosure activity we saw during the Great Recession. So what does all this mean? It means that the housing market surge will probably continue into 2021 because of demographics, low mortgage rates, and some of the accelerated trends we saw due to the pandemic. Very likely that we're going to continue to see home prices rise until builders ramp up and we see more existing homeowners list their properties. We're going to see default activity increase, but probably not at the levels we saw during the last session, although commercial markets could see higher than usual amounts of default. FHA loan portfolio is the most vulnerable in the home business to see potential defaults, and where you have regions with high concentrations of FHA borrowers, we could see market conditions change. The markets with the highest concentrations of single-family rental properties could be at risk due to the government's eviction bans. We just issued a report on the markets that are most vulnerable at RealtyTrac. Feel free to check out the news section of our website to see that report. And most likely scenarios, we won't start to see any measurable increase in foreclosure activity until the second half of the year, once the mortgage forbearance program has expired and the mortgage the foreclosure moratorium has expired as well. So probably not until Q3. It'll probably start gradually. And then the activity will happen on a state-by-state basis. So much more quickly in Texas, which has a 30-day foreclosure cycle, than New York, which can take 3 years to get through a foreclosure. So I hope this information has been of use to you. I hope you found it somewhat interesting. We do get a lot of questions about how many foreclosures, where and when. And we're trying to provide some answers looking through our crystal ball. We hope that we're closer to right than wrong, because another wave of foreclosures like we saw last time really isn't in anybody's best interest. So with that, I will turn it back over to my colleague, Jennifer, and leave the rest up to her.
Thank you so much, Rick. Again, so please make sure to submit any questions in the questions pane, and we will be sure to answer them within 2 business days. I just want to thank everyone so much for joining us. Please visit our website, attomdata.com, for more information on ATTOM and to keep up to date on the housing market as well as current climate of the market. And just another reminder that the webinar was recorded and will be emailed to you within 48 hours to the email address you provided. Thank you so much.